from Brayn Consulting on A&E Deductions, the CARES Act, and making the most of 2020. We'll have a brief Q&A section towards the end, and then we will close out with a review of some of the upcoming events that we have here at the AIA New Orleans. Our presenter today is Jason Villery. Jason joined Brayn Consulting LLC in 2018 as a business management professional. Jason has over 17 years experience with treasury management, internal audit consulting, project accounting, financial reporting, and managing sales teams. Jason is a skilled leader with demonstrated ability to effectively achieve process improvement, manage change, and create diverse, cross-functional, quality-driven teams to implement corporate-wide improvements. And with that, we'll hand it over to you, Jason.
Thanks so much. I appreciate it, Lauren. I like how I got my old picture up there. That's how you stay young, I guess. Let me go ahead and share my screen here. I appreciate you guys for joining. Today, what we want to do is talk about specific A&E deductions, largely the R&D tax credit as well as the 179D. And then making the most of the CARES Act, right? And what's going on in 2020, trying to develop some of those tax advantages and incentives to where it can create additional cash flow, right? So what we're going to do today, and I'd just like to kind of go over these learning objectives real quick, is talk about the R&D credit, the 4-part test. What are the exclusions? Like, why wouldn't I qualify? Why do I qualify? Look at non-funded research, as well as identify those target-rich environments for R&D. Next, we're going to talk about the 179D energy efficiency commercial building tax deduction, how to identify eligible projects, and understanding the process for claiming that 179D. We're going to talk a lot about the project tracking versus activity matrix and how to maximize your R&D credit, and then understand how these different tax incentives fit into any changes within the CARES Act of 2020. So I appreciate the introduction. I still got the young picture up on here, but anyway, I'll move forward into the presentation on R&D tax credits. I think that the most important thing to do when starting off this conversation about the R&D tax credit is really talk about the history of it, right? Because the history of the R&D credit really kind of exposes why it was intended and what's the application of it, right? There are two different legal codes for R&D within the IRS tax code, right? There's section 174, which is R&D expenses, right? And it's a big bucket, and it's just a deduction. And then there is the section 41, which we're going to talk about today, is the R&D tax credit. This was enacted in 1981. In 1981, the Economic Tax Recovery Act decided that we wanted to do two things. One, you wanted to keep technical resources in the United States, right? So the intellectual property that was building within the US was all getting shipped overseas. Well, how do you keep that in the US? You incentivize firms to keep those technical resources in by allowing them to claim a valuable tax credit incentive, right? In 1981, this was really done and focused on more of the infinity and beyond types of research and development, right? You had to have a patent, you had to have some type of invention, very, very R&D heavy. As this credit evolved in 1986, the Tax Recovery Act really passed some more laws on qualified research and what actually qualified. So what that did is that really started to broaden the disciplines, right, of who could potentially qualify for it. In 2001, they eliminated the Discovery Act, right? So no longer did you have to have patents and inventions. R&D didn't have to be new to the world. It just had to be new to you, right? And so that was the importance is This really started to, all the technical disciplines that are in the AE space really started to say, okay, this does now apply to us, right? We are the technical resources um, that this credit is looking for. In 2003, the final tax regulations came out that really broadened specific definitions of the four-part test, which we'll talk about later. But that really just meant for opening the doors on more organizations and industries that could qualify for this and claim the credit. In 2015, again, more expansion of the R&D credit. This allowed companies that were smaller businesses, startups, things of that sort, to take the R&D credit. Typically, there had only been one federal calculation method for the R&D tax credit. In 2015, they came out with another method called the alternative simplified method, which allowed really, like I said, more expansion, more opportunity for smaller companies to take the credit. It also allowed in 2015, that PATH Act allowed you to take the R&D credit as a payroll tax credit, right? So startups that were in specific R&D technical spaces could then use the R&D credit dollars to offset their payroll tax expense. So very valuable credit. But again, you can see over history how it's evolved, but the intent is really to keep those technical resources within the US, allowing you a credit to claim to increase the infrastructure or the technology that you have within your business, or hire and retain talent, right? So just some basics, and it's important to note here that there is a federal R&D tax credit, and then there is a state R&D tax credit. Today, we're talking about the federal R&D credit. The state credit, and I'll touch on that just for a moment, the state credit in Louisiana has a much different qualification. The state credit doesn't allow you for customized machining. The state credit doesn't allow professional services companies to qualify for the credit. So there's what happened is the state didn't like all of the businesses going in to claim the credit, and so in 2017, the Louisiana Economic Development Group went ahead and said, look, in order to do the state credit, you have to be in more of a patentable type of industry, more of a patentable type of product, things of that sort. So very much more difficult to claim for AE firms, in a nutshell. So from the federal side, if this is a permanent tax credit, it's been around since, like we said, the early 80s. In order to reverse this tax credit, there would have to be a 2/3 vote in Congress. It would be detrimental to the intellectual property that's in the US. So I think that both parties are in line with continuing this to be a good credit that develops over time. It's also one of the more underutilized credits within the tax code. It was estimated in 2013 that the government had offset upwards of $10 billion a year for this credit to be claimed, and less than 13% had been claimed year over year. So qualification. So who qualifies? This is the important part about the R&D credit. The qualification is it's an activities-based credit, right? So you have to be performing activities that meet a four-part test. So it's much more broad than just traditional definitions of R&D, lab coats, test tubes, beakers, things of that sort. So you really have to apply this credit based on that four-part test. So once you decide that, hey, I am meeting the four-part test, how do you quantify the dollars that are associated with that activity, right? If you're doing a schematic design, how do I associate that? Okay, well, that schematic design that meets a four-part test, it qualifies. What's involved there? Wages, right? Wages are the number one research expense for architecture firms, right? So that means box one wages. That means self-employment earnings. It can mean advanced payments. It can mean a multitude of things. The second thing is supplies. Now, this is going to be on a lot smaller of a scale, right? So, but if you are doing projects that require specific prototyping, the supplies that are involved in putting that together and constructing that could potentially qualify as well. The other research expenditure that would qualify as contract expenses. So um, if you have a third-party contractor that's also helping in the design of a specific building that you contract out to, up to 65 cents on the dollar could qualify for that contractor. Now, again, and the reason why they give you less on the contract expenses is because they want you to keep um, those bodies in house, right? They want you to hire and retain talent, and so again, that goes to the intent of the overall code. So, what's it worth to you? This is a good one. Up to about 8% of QREs. And so, what I usually say is, if you have an architect making $100,000 a year, and let's say it's an associate, and that associate is doing nothing but AutoCAD, BIM modeling, heavy design, R&D direct activities, then 8% of that salary, $100,000 or $8,000, could be a credit annually for that R&D work, right? So the credit can be substantial, right? Because in order to make $8,000 in cash flow, you would need, at a 20% margin, you'd need $40,000 in projects sold, right? So it's important to kind of look at that, the net effect of that credit. And like I mentioned, utilization for it. If you get an $8,000 tax credit, that can offset $8,000 of taxable income, right? So that is dollar for dollar cash. Very valuable. And then when you talk about carryovers, you can carry back 1 year and you can carry forward up to 20 years on the federal side. Okay, so this is kind of where the rubber meets the road with this tax credit, right? It's an activities-based credit, but the activities you're performing needs to meet the 4-part test, right? Okay, so when we look at the 4-part test, let's associate an architectural project of a delivery of construction documents for $100,000, let's say. So 4-part test, test 1, you're creating a business component for permitted purpose. So you're creating a new product or process, technique, formula, but it has a permitted purpose, right? So it can't just be for cost efficiencies and things of that sort. It has to be to produce reliability, quality, durability, functionality, things of that sort, right? So the one product that you're creating as an architect firm is that set of construction documents. That's your one product, right? So that's how you meet the first test. The second test is uncertainty. And so uncertainty, like we mentioned earlier in the history of the R&D credit, uncertainty used to be in capability and methodology, right? So can this be done? How can it be done, right? And although those characteristics exist, there also is another characteristics that within uncertainty is the final or appropriate design. So there doesn't have to be uncertainty in can this get done? Sure, I mean, like, you can do drawings, but the appropriateness and the final design of that is how architects then meet this test, right? So typically you don't have Rev 1 and done, right? And so because of that, that shows that you're having uncertainty through some portion of the life of the project. And then of course the process of experimentation, the 3rd-part test. So the systematic review of alternatives, right? Redesign, anything related to that overall change in evaluating materials, trial and error, things of that sort. All of that is a process of experimentation. All of those iterative things that go into that design development phase, meeting that process of experimentation, right? Going back and forth and seeing if this works. If I rotate this building X amount of degrees, how much light am I going to get in? Do I need a thicker piece of glass? Things of that sort. All of that is uncertainty and going through that process and determining the best alternative is that process of experimentation, right? And then the 4th one is technological in nature. What this means is, again, back to the intent of the code. We want the R&D credit to be based on hard sciences, right? The technical resources, the engineerings, the physics, the biologies, all of those highly technical resources, uh, principles, engineering principles, things like that, that are very technical in nature, right? And so you're creating a set of construction documents of which you do not know the end design as you go through a systematic trial and error process. Um, we call it, in just one simple phrase, evaluating solutions to overcome a technical uncertainty. And architects do this on a day by day basis, on a project by project basis, and actually by activity. So exclusions, there are some exclusions to this tax credit. One of the exclusions is R&D that's outside the US. Again, this is a federal credit. 35 states have some portion of an R&D, some program of an R&D credit. So if you have people that actually, if your firm has people in Texas, they could potentially get a Texas state credit, right? We mentioned Louisiana doesn't have a good state credit for AE firms, but Texas does, Florida does. So it's important to know that the physical location of where you're sitting is important. Any architectural work that's done overseas would not qualify, right? It's a federal credit. R&D after commercial production has started. This is an interesting one for architects because in going through your contracts, there is a portion of construction admin, right? And so that construction admin, we can typically say that a lot of the activities that are done there are more of oversight in the installation of the design, right? So it's more of the construction process, right? So that wouldn't really qualify and meet the 4-part test, right? Because you're not providing at that point, you're not providing any more product, you're providing just the service, right? Um, However, if you are out in the field doing construction admin and you are gathering, let's say a project manager, and you're gathering information that helps in the redesign of something, of an overall structure, then that would potentially qualify, right? So a lot of times I have clients that say, well, how do you know how much I spend in each project? Well, we don't have to know each project. We just have to know a majority. Like, what's the process? What's the process that you're doing? How aligned are you? Like, you want to look at your contracts because that really tells a lot of the story. We have some clients that have up to 30% in construction admin, right? So that means they'll have a lower qualified research expense to total wage, right? We have some clients that have 10% in construction admin, and then they have quite a bit of expenses and more activities being done on the front end, doing more feasibility studies and things of that sort. That's all analysis that goes into affecting that overall design, right? And so it's important to know where the activities are within that contract lifecycle. Reverse engineering, you simply can't take something apart and put it back together. It's got to be new or improved, right? Efficiency surveys or marketing activities. This is another good one. A lot of our civil engineering firms that we work with, if they're doing a survey and that survey is they call them mom and pop surveys, right? They're just going out there saying to you, here's what your house looks like, here's a survey. That those wouldn't qualify. But if you're doing a survey on a site selection to then have an overall design, and that survey is part of the overall project and part of the overall contract, well, then that's an activity that's needed for the inputs of that project, and it could affect the overall design, right? So then that would potentially qualify. So we have exclusions, but then we have caveats to these exclusions, right? Aesthetic and cosmetic or seasonal type designs. So anything that's done aesthetically would not qualify, right? And so when I look at this for architects, I think, okay, interior design, right? Anything that is not technical in nature, it's more on the aesthetic portion, which is interior design, would not qualify, right? But we also have clients that do interior moduling, right? And so that's a very technical design aspect to that, right? As they have to do the remodeling of space, they have structural analysis and supports to do, things of that sort. So then that activity would qualify, right? So it's really breaking up what's really being done by that person, right? And then funded research, this is the most critical concept. Um, and what funded research means is that if you bear the financial risk and if you own or retain substantial or even limited rights to that research, then a contract is deemed as not funded. Now, what funded means is if your contracts are deemed as funded, that what that means is one, you don't retain any of the rights, right? So that research that you did, you don't have any rights to that information to ever use again, right? The second thing is the amounts that are payable under the agreement are contingent upon the success of the research, right? Meaning that you didn't have to bear a financial expense to that, right? So in cases where you are being paid hourly, right? If you had a contract that you were doing hourly, you wouldn't be bearing that financial risk, right? Because they're paying you hourly for everything. And what you're doing is not contingent upon the success of that research. It's just contingent upon the time you spend into that, right? And so that's where funded research versus not funded research is an important concept. In 2019, Populous Holdings claimed R&D credits for prior years, and in 2019, the courts upheld a ruling that work performed under fixed fee contracts by architects would qualify for R&D. So it was a substantial win towards the end of 2019 that said that the work that they're doing under fixed fee contracts meets the term of not funded, right? So they're not funding that research because they're bearing that economic risk. And if you bear that economic risk and you retain the rights, then that project would qualify for R&D. So it's a very, very important concept here. So when we talk about like optimizing the R&D credit and like what's involved in an R&D study, I think it's important to know that, again, focusing on the activities that are being performed. First and foremost, what activities are you being performed? How are we supporting it, right? The R&D credit has two major components. It's the calculation and then the documentation for support, right? The calculation is done based on, well, for architects, a lot of your wages, your contract expenses, and any potential supplies, probably very minimal, almost none. So any types of dollars and expenses that are in those buckets, right? Then it's also putting a time on those wages. So how much time did you spend getting up to those construction documents, the planning, the programming, conceptual design, all the way schematic, design development, all the way to construction documents? And then are there any potential activities post-construction documents that also help in winning that project, right? Anything in the construction bidding or construction admin that help to affect that overall design or redesign of those construction documents, right? So you want to identify the activities, right? So what activities are we doing within our process? Who's doing those activities, right? And then where are those expenses located, right? So that's the important part. So after you've kind of looked at that, you also want to look at all your projects and processes. So overall, you're going to do a process description. What does our process look like? What's happening at each one of these phases, right? Within our phases. And then you're going to look at projects too. You're going to want to look at some projects I get questions on all the time are, well, I have cost plus fixed fee. Okay, does that qualify? Well, there are multiple terms within that contract, whether it's under warranties, whether it's under payment schedule, things like that, clawback, terms within a specific contract could really change the intent of the overall contract, right? And that means whether it would qualify versus funded or not funded. I think an important thing to note in here is that with most architecture firms, you have time tracking or you don't, right? But that doesn't preclude you, whether you have it or not, doesn't preclude you from taking and claiming the R&D credit. If you have time tracking, if you have the Deltex and you have the, Visions, Ageras, You got Microsoft Dynamics, Cores, all of them. If you have time tracking, what that does is it really helps you substantiate the credit, right? Hey, we did all of our work within these phases. This is the time we spent. This is how much I paid this person. Clear, cut and dry, right? That's how you substantiate it. These are the projects that qualify that were not funded, and so you'll look at all of that. But makes it much easier at times if your time tracking is good, right? Sometimes what an R&D study also will help you do is identify areas in your time tracking that aren't consistent, right? It'll help you improve your time tracking, help you clean it up a little bit, which I think that is one part of, like, when you talk about optimizing the R&D credit. Your first year you do a study, you might say, oh man, we didn't really do that well. Well, over time, your time tracking could potentially get better, right? And then that could end up helping your overall R&D credit as well as your overall operations, right? The next thing is when you look at an activity matrix, right? So if you don't have time tracking, but there are specific case law and scenarios that allow you to estimate and allocate a percentage of time that person spends in these specific phases, right? And so there is case law that kind of helps you support that. But what's most important when you're using an activity matrix is other forms of documentation that can help substantiate that credit. By definition, if you hire someone to be an architect, okay, then that person is not doing accounting, right? If you hire someone for accounting, they're probably not doing architecture, right? And so you want to make sure your activity matrix really defines what their role is within the company, right? How often are they doing direct R&D? How often are they supervising R&D? How often are they supporting it, like with your interns, right? Your interns supporting R&D, gathering information, researching information on specific regulations and codes and things of that sort that directly affect projects, right? So really, it's that activity matrix usually takes more of a discussion over with the overall process, but not too much more than time tracking, because with time tracking, you still got to associate those phases, right? Those phases, what's being done. So time tracking just gives you a little bit extra kind of security, right? Because it's kind of, as IRS agencies look at it, time tracking allows you a little bit more of a cushion, right? It allows you support. It's better. It's better data than an activity matrix would be, but both are allowed within this credit. This is an important slide here because we talked about roles and where we see the expenses for specific roles, right? And when you're looking at R&D, what you want to do is the people that are doing the direct R&D activities, they're going to be highly concentrated, right? That's going to be that real big bullseye. That's going to be your architects, your engineers, CAD, BIM modelers, designers. Very heavy R&D, maybe 85 to 90, 100% of their work is all drawings, right? As you get to further outside that direct R&D, you're going to get to levels like partners, principals, department heads. They're going to be really focused on that supervision and support, right? Really like supervising sign-offs on projects, department heads overseeing specific projects. So you're going to get more on the supervision, a little bit less on the direct. It all depends on the size of firm and the activities that are being done, right? Oops. The next level too is your project managers and your QA engineers. When you look at project managers, like we mentioned, if you're spending a lot of your time in construction admin, then you're going to want to have your R&D provider document the types of admin activities that you're doing, because you might be doing more redesign activities, right? You might be doing more support functions that help in that overall redesign, where it goes back to the CAD drafters and they have a new design for that project, right? So it's important to note that there can be some support, a lot more support activities within those project managers. Surveyors, interior designers, we talked on that a little bit. Again, aesthetic in nature won't qualify, but if that interior designer is doing something to structurally affect the design, or provide support within that design, that could potentially qualify. Okay, so right here I got a quick little example. This is a 36-person firm, an architecture firm, the AE firm. So they do a little bit of engineering. They do a lot of the building design, master planning, subsystem engineering. A lot of time spent, most of their time spent in schematic design, design development, construction documents phases. 36 people. Their payroll is at $2 million, and they identified 900,000 in qualified research expenditures. So about 45% of their time was spent either doing direct design work or support and supervision of design work, right? So any of those activities was meeting that total payroll threshold. So about 45% of their time. That's probably a pretty reasonable estimate, based on a lot of architecture firms that we deal with, especially at this size. At 36, that's where you start to see it thinning out a little bit more. So getting more into the 40s and maybe even 35s as they continue to get larger and larger. But again, with fine-tuned time tracking, with smaller firms, you can get it's not crazy to see that 900,000 be 1.5 million, right? 75% of your time is spent into that strict design, right? Maybe they have fewer projects, and if you have fewer projects, you're sometimes doing less of the bidding, less negotiating, things of that sort. So a smaller admin portion. So there's a lot of different activities that could affect the overall QREs and the percentage of QRE to payroll. So it's important to look at that. But this company had 900,000 in qualified research expenditures, and they identified 72,000 in net federal credits, which I believe is about 8% or so. So that was on the larger end of the spectrum. Okay, so CARES Act. So what's this mean in 2020? Now that we have the CARES Act, so R&D, and we'll talk in a minute about 179D, but R&D and 179D do not have any changes within the tax code based on the CARES Act, right? So there's no wholesale scale changes. The credits and deductions will go as they have in prior years. But they did say that if you had net operating losses in prior years, and this is where we're going to get really too tax technical, right? If you had net operating losses in prior years, you could open up prior years and go back and claim those specific tax credits or incentives, right? And then carry back those net operating loss in years that were potentially closed, right? What does it really mean? It means that if you had previously losses in prior years, right? You could use tax credits to offset those prior year losses. So whereas you used to only have a carryback in R&D credits for 1 year, you can carry back up to 5 years, right? And you could take the entire amount of NOL and wipe it out, right? Not just up to 80%. So this gets really tax technical, and we got an example in a little bit, but I'm going to kind of run through it because I think more important than anything for your education is just what are the opportunities that are out there, and then let my accountant talk with my R&D guy, right? So I think that's probably I'd like to stick more on the content that is associated with you guys. There is an article though, if you do want to read up on it, for NOL changes and the value of that, that we put on our website. Okay, so 179D, energy efficiency commercial building deduction. This is a tax credit that was extended, right? As R&D is a little different. R&D that we mentioned is a permanent in the tax credit, right? 179D is an energy efficiency credit, energy efficiency incentive that is on an extenders package, right? And so that gets extended with other annual incentive programs. Typically it gets extended before the next calendar year. But we had obviously some things going on this past year and the year before that pushed this deduction, right? It got approved at the beginning of 2020 and backdated through 2018 property all the way through the end of 2020. So any building that was put into service prior to 2020 has potential to claim. Now you can really only go back up to 3 years, right? Unless you had net operating losses, and we'll explain that. If you had net operating losses in prior 3 years, which is go back to 18, then you could open up potentially 5 years of prior taxes to claim the 179D or the R&D. So what's the value of this deduction, right? The energy efficiency deduction was put in place to say, if you are a designer, a builder of government buildings, or a commercial property owner that has basis in the property and the design, then you could claim a energy efficiency credit for up to $1.80 a square foot, right? This is all related to specific property in the HVAC, the hot water system, interior lighting. That's a big one. Anything on the building envelope. This pertains to either new construction, renovation, or addition. So it's really the larger the building, the larger the incentive, right? It's subject to specific limitations. You can go back up to 3 years. It does require a certification by third-party professional engineers, right? So that's an important part of it. And again, any of these buildings will need to go through that certification. They're going to look at testing airflow through specific door openings. They're gonna look at and test the HVAC system, any types of lighting and the energy put off by that lighting, things of that sort. So although it's a extensive testing process, the standards to obtain this energy efficiency deduction are relatively common in their application. Okay, so 179D for designers and builders, right? So here's the way it works is that typically, if you're a commercial building owner, right? You own a commercial building, you can take the 179D because you have a basis in that property. So you can take 179D for creating that energy efficiency standards. However, if it's a government-owned building, what they've now allowed you to do is say, since 2006, is say that government entity can allocate up to $1.80 a square foot for the architect, the mechanical engineer, the contractors, specialty lighting contractors, things of that sort. It can allocate up to $1.80 a square foot to those designer or builders, right? So this means anything like schools, universities, prisons, GSAs, hospitals, things of that sort. Any type of government-owned building that you design could get up to 180 a square foot. And I think it's important to know that, here's a case study right here for an architect firm. One important part of this process before we kind of jump into this case study is that that allocation letter process. So the government-owned facility issues you an allocation letter and says you can as the architect, you can get up to $1.80 a square foot. However, that governmental body can break it up, right? And they can allocate 60 cents to the architect, 60 cents to the electrical contractor, 60 cents to the mechanical engineer, right? Things that sort. So they can break it up, or they can do it all in one, right? But it's really the main thing about 179D is that allocation letter process. Does the government body have to go to all of the entities that are associated with the project to offer them 60 cents? No. Do they have to say right off the bat, give it to the first person? No. So it's really at their discretion as far as who they issue that incentive out to. So it's really kind of like a race for the courthouse, we call it, is in getting that in. And so like a lot of times is what we would want to do is look at all the potential government-owned properties, create allocation letters, go to the specific governmental entities, and make sure that we have some consistency with it, right? To where we can try to develop consistency from that governmental organization on how they issue their allocations. So it's important. It's a very, very critical process. Okay, so this is a case study for an architecture firm. They do both new designs, they have renovations, offices, universities. So they're doing a lot of government-owned property. In 2013 through 2017, they had taxable income of about $1 million. Before the CARES Act, that ended up being $350,000, right? Well, now that the CARES Act is available, what they can do is they can go back into prior years and claim the R&D credit as well as 179D credit, and they can take that $750,000 and they can reduce their taxable income in the prior years, right? So their tax before the CARES Act was $350,000, right, based on a 35% rate. Well, they reduced their taxable income by $750,000, and so now they only owe $85,000, right? So it can be a substantial advantage to be able to open up your prior net operating loss years and being able to kind of take those back. So that's just kind of the quick addition right there. Within 179D, though, we've identified, completed in 2018, 3 different projects: university building, a middle school, and a university garage, all allocated a different amount, right? And a different qualification, right? So it's important the university building, 150,000 square feet, was allocated 100%, right? So they got the full $1.80. The middle school was allocated 50%, and they got $1.80 a square foot. And then the university garage was allocated 100%, and they got 60 cents on the dollar for that, right? So you probably had other lighting contractors or other different designers that were associated with that project, right? So that led to about 528,000 in total deductions for the 179D credit or 179D deduction. And then that ended up being, that reduced your taxable amount to 700,000. Before the CARES Act, you had a taxable, or before the CARES Act, you had a taxable income of about 440,000. And then it went down to a taxable income of 210,000. So ultimately, the balance of these credits and deductions will carry back to prior years and wipe out potential net operating losses in prior years, right? So it can be significant savings. It could generate future taxable savings to kind of net out against future taxable income. So this is an example of a couple different 179D projects, but again, R&D is also applicable to go back as well within, if you're going to open up prior years for net operating losses. Okay, I want to leave a little bit of time for questions, so I'm going to give some takeaways here. R&D credits, again, it's available to many industries over time. Again, let's focus on the intent of the overall credit, why it's there. It's there to keep technical resources in the U.S., help you to invest in your business, retain talent. It's a dollar for dollar credit. So what I like to say is that, if you have a payroll of $1 million and you have potential QREs of about 500,000, that's going to produce a $40,000 annual credit. If that produces about a $40,000 annual credit, that's the equivalent of about a $200,000 job, right? And so how much time and effort does it take for you to make or to sell a $200,000 job? On a study with a payroll of $1 million for an architecture firm, it'd probably take 15 hours for us to complete. And that's 15 hours of your time, right? And so the time it takes to get to get it off the ground, and the time it takes to do the interviews and the process, and look at time tracking versus activity matrix reviews and things of that sort, about 15 hours of your team's total time. So is that worth the $200,000 potentially, right? 179D tax deductions. Again, the biggest thing for that is, as an architect, any governmental owned property, you're a big beneficiary. However, that process is really run by the allocation letters, right? So the allocation letter process is important to make sure you get out ahead of that. You can submit for an allocation as soon as you win a bid, right? Because you have an interest in that project, right? This has been completed and extended for 2018 through 2020. Again, we can go back for prior years if we need to, if it means opening up prior years net operating losses, or if that's not the case, then we can just go back prior 3 years to go ahead and see if anyone's claimed those deductions for that building. And a lot of times, if those deductions for governmental properties go unclaimed, and you come in after the fact, they'll write you a letter pretty easily and pretty quickly, because no one's came to them and requested it, right? And this happens, I'd say, about 20% of the time. So something to take a look at. It's a quick win. I like to call those quick wins. All right. So I've left looks like about 5-6 minutes or so for some question and answer. So I wanted to see if anybody has anything I can help with.
And while we're waiting for folks to type those into the Q&A box, let me just go ahead and share some of the events that we've got coming up. So this Thursday, November 12th, we have the Small Firm Exchange meeting. And then that evening, we have our annual members meeting where we'll be doing an overview of the past year and everything that we've been working on, as well as electing our board members for 2021. And then on November 20th, we have our final installment in the Storytelling with Architects series with Melissa Rome of Rome office. And one of our final webinars of the year is going to be a town hall with the Bucare Commission coming up on December 11th. And you can register for any of those on our website, aineworleans.org. And any questions about those, you can reach out to me, Erin Donovan, at aineworleans.org, or our content coordinator, Lauren, at aineworleans.org. And let's see. Doesn't look like we've got any questions in so far. Jason, did you want to share your contact information in case people digested and wanted to come back with questions for you?
Absolutely. And then let's see. Here's my contact information below. Connect with us on social media, as well as my LinkedIn, my phone number. I'm actually based in New Orleans, but I got a Baton Rouge number. And then my email address down below. So, and I guess my main takeaways are There are valuable tax credits and incentives out there for architects. These are designed for you. I think an important thing to note is companies like AECom completely wiped out their entire tax liability in 2018 by claiming a $153 million R&D tax credit. AECom is doing some of the same activities as firms that we talk with at AIA, NOLA, and throughout the state. So it's an activities-based credit. So we are happy to help claim.
And it looks like we do have one question in there asking about fees for these services.
Yeah, so that's a good question. I mean, typically the fees are going to be based on the overall project, the complexity of it, the size of it, things of that sort, right? There are two different ways that companies can charge, right? So you can charge a fee based on a contingency, right? And so like, let's just say like, I'm going to charge you 35% or so of the total credit you get back, right? Our fees, our firm's a little different. We use a fixed fee model. So there's no surprises. We do a conservative estimate in the beginning. From that estimate, it's a third as you decide to move forward with the project. A fixed fee looks a little bit better under audit. It doesn't look like you're pushing the envelope, and that's not to say that you are as a contingency firm, but it looks a little bit better under audit. And so sometimes perception under audit is most important, right? And so we've always been on a fixed fee model, but you can get fixed fee and contingency. But yeah, I'm happy to talk more about our individual fees. Offline, they're pretty reasonable. We're a smaller firm. We're a small niche firm, so I'd say 60% of what we do is R&D tax credit, and about 55 to 58% of our client base is AE. Good question, though.
Great. All right. Well, Jason, thank you so much for joining us. Thanks to all of our attendees. We appreciate y'all not coming out, but I guess hanging out where you are and joining us virtually. And we'll see you all again soon.
Thank you, guys.